Welcome back to The Exchange. President Trump declaring a national energy emergency on his first day in office, aiming to boost production and strengthen America's energy independence. But my next guest says, forget production incentives. The U.S. should join OPEC Plus. Not only will that stabilize energy prices, he says it would give America a leg up on China. Here to make the case is Sean Filer. He's the Chief Investment Officer of Equinox Partners. Sean, it's great to see you. Welcome.
Thanks, Kelly.
On a day like this, it's all out the window that we get lower oil prices. The economy's a problem. We don't need to worry about the Mar-a-Lago Accords anymore. Tell me, though, why? I mean, stabilizing oil prices, yes, let's put aside the sort of geopolitical history with OPEC. Wouldn't that raise costs for consumer? It seems like the president now, with everything that's happened, will probably want to do the opposite.
So the idea that we were going to produce 3 million additional barrels a day and that was going to drive the oil price down, I think that idea sailed pretty quickly, and we saw that idea in the second inaugural, and then by Wednesday he was calling on OPEC. So if Trump wants to control the oil price, he's going to have to work with OPEC in some way. OPEC is just under half of the world's oil production, and their mandate is to stabilize the oil price. And so I think that conversation and that partnership is going to make sense because of the coincidental wants here.
But what you're talking about would be great for oil producers if we kind of were all part of this idea. Yeah, maybe a little bit higher or a stable oil price. But again, I thought that he and Besson and everybody are trying to bring costs down. I think they're going to have to do more now because look at how consumers are pushing back on high inflation in the first month already of his term.
Yeah, but the problem is just there's a geological reality that the Trump administration is dealing with, and you have oil production in the United States flattening out, not increasing at $70 oil. And you can see this in the oil service companies and the U.S. Oil and gas companies themselves, as there's just not an appetite to drill and expand production in the United States at these oil prices. And so if Trump wants a freer hand to do things like increase the maximum pressure campaign on Iran, he needs to do a deal with the Saudis, he needs to do a deal with OPEC, and he needs to do a deal with Russia.
Well, it makes me think that even if we didn't do something like this officially, that it could be de facto policy, which is fascinating. So anyway, let me move on, Sean, and talk about something maybe a little less controversial, which is gold. Highly consensus. Everyone's starting to understand now the central bank gold buying. But what inning of this are we in? How much further could this go? How much higher could the gold price go?
So gold prices have almost doubled over the last 5 years. So and over the last 4 years, we've added $1,000 to the price of gold. And the largest buyer in the gold market are central banks. So a lot of the forces driving central banks to buy gold are not going away. So the over-indebtedness of the United States, the concern about U.S. macroeconomic policy and U.S. restrictions on the dollar, right? So the 2022 freezing of the Russian foreign central bank assets has had a real chilling effect in terms of global demand for dollar assets from central banks.
Yeah, and the interesting thing about this is, to me, it's sort of once everybody knows and once everyone's piling in and assumes it's going higher, I'm kind of looking for the next piece of the story. But you think this is the story?
Well, yeah, that 1,000-ton a year of demand from central banks, that's been consistent now for 3 years. And, in terms of net additions to central bank balances of gold reserves, that's been true since 2008. So this is not the first inning of the story, but I think in terms of the continuing demand for gold from foreign central banks, and then the other issue that you addressed with the Mar-a-Lago Accords, right, that waning demand for longer dated U.S. Treasuries that you see from foreign central banks. So those are two sides of the same coin, and I don't see that dynamic changing anytime soon.